Silver isn't scarce on charts. It's scarce where it actually counts. Right now, not someday, not after a crisis headline. Right now, registered silver at COMEX is draining toward levels we haven't seen in years. Roughly 120 million ounces, and still falling. Delivery requests are pushing into record territory. Trading volume is spiking. And price? Price is pinned. That contradiction is the signal. If you're stacking physical, watching macro pressure build, or just trying to protect what you've worked for, this matters. And if you're hearing this now, you're ahead of the crowd that waits for CNBC to explain why metal suddenly disappeared. Here's what we're doing today. We're not predicting prices. We're teaching patterns, structures that repeat, mechanisms you see again and again in silver, gold, copper, anything physical that's been layered with paper leverage. Your job isn't to guess timing, it's to understand structure. So let's strip the noise. Before we go any further, quick pause. Subscribe if you haven't. We track what others ignore. We watch flows, not headlines. And drop a comment with one word: stacker, watcher, or trader. I want to see who's actually in the room. All right. The registered inventory at COMEX, the ounces that are actually available for delivery against futures contracts, has been bleeding out. Not slowly, aggressively. Over the past several months, drawdowns have accelerated while delivery demand stays hot. Volume surges, open interest expands, but price doesn't respond the way textbooks say it should. Why? Because most people watch price. We watch supply. Quick clarity, because this matters. Eligible silver sits in COMEX warehouses, but isn't pledged for delivery. Registered silver is different. That's the live ammo. That's what can actually be delivered when a contract holder says, "I want the metal." When registered shrinks and delivery requests spike, the system's flexibility shrinks with it. And right now, large institutions like JP Morgan Chase and Citibank, not villains, just dominant players, control massive positions across both paper and physical markets. Their movements shape outcomes. When metal gets reclassified from registered to eligible, when warehouse receipts get shuffled, when contracts get rolled forward, those aren't random clerical decisions. They're pressure responses. Most people stop digging there. That's where this actually gets interesting. Think about the market like this. Paper contracts act like a pressure valve. Physical supply is the tank. Futures, options, swaps. Those instruments let demand trade exposure without demanding metal. As long as that valve works, pressure gets released. Price looks stable. Liquidity looks deep. Everything appears fine, until the tank runs low. When physical supply drains while paper claims keep expanding, you get a divergence. The valve keeps releasing pressure that the tank can no longer support. Leverage builds on top of a shrinking base. And here's the key. There's no alarm that goes off. No flashing sign that says, physical shortage approaching. You see it in the flows. Dealer premiums start creeping higher. Lease rates tick up. Bars quietly move from registered to eligible. You start seeing backwardation in short-term contracts, where near-month futures trade above later months. That's not normal. That's stress. This valve versus tank pattern isn't unique to silver. We saw it in palladium in 2020, nickel in 2022, energy markets during past squeezes. Paper markets can suppress visible stress for a while, but they don't eliminate it. They concentrate it. And when the valve finally sticks, when someone demands metal and the answer becomes, "We need a few days," or "How about cash instead?" price doesn't rise gradually. It gaps. That's why silver can feel confusing if you're only watching charts. You see volume explode. You hear bullish narratives. And price just sits there. That's not patience. That's contained pressure. Think of it like musical chairs. The music is still playing. People are still trading contracts. But the number of chairs, the physical ounces available for delivery, is shrinking. If you're holding a contract expecting delivery, you're playing that game. If you're stacking physical, you're holding the chair. And if you're on the sidelines wondering why silver should be higher but isn't, this is the answer. The valve is still working. Barely. Your job isn't to predict when it fails. It's to recognize the setup so you're not shocked when stress becomes visible. You're informed. Now let's add the second layer, because this is where things compound. High delivery demand doesn't just drain inventory. It forces a cascade of small decisions, each one buying time, each one increasing fragility. First, warehouses reshuffle metal. Registered silver gets downgraded to eligible. Not because it vanished, but because the owner no longer wants it pledged for delivery. Maybe they're holding out for higher prices. Maybe they're moving it off exchange. Either way, registered supply drops while eligible rises. The metal exists, but it's no longer available to settle contracts. Second, cash settlement incentives increase. Instead of delivering metal, shorts offer a premium to close out in dollars. That works, until someone actually wants bars. When a participant needs physical silver, not exposure, that negotiation gets expensive fast. Third, administrative adjustments appear. Margin requirements get raised. Delivery language gets tweaked. Contract terms get clarified. It's never called rationing. It's called maintaining orderly markets. Every step buys time. Every step widens the gap between paper price and physical reality. Now imagine you're a refiner or manufacturer. You hedged future production by shorting futures. Delivery demand spikes. Registered inventory is thin. And suddenly settling that hedge means sourcing physical metal at premiums far above the futures price you're locked into. That's not just a bad trade. That's an operational scramble. Or imagine you're an industrial buyer who relied on COMEX pricing as a stable reference. Suddenly your suppliers are quoting premiums that seem disconnected from spot. That's because spot reflects paper liquidity. Premiums reflect physical scarcity. That divergence is the tell. We're not saying COMEX is about to default. We're not calling a force majeure. We're showing you how stress manifests before anything dramatic happens. Lease rates are one signal. When it costs more to borrow silver short-term than long-term, that's backwardation. That's urgency. Physical premiums are another. When bars cost 15 or 20% over spot and delivery times stretch out, that's not greed. That's tight supply. Reclassification is the quiet signal. When registered drops and eligible rises without metal leaving the warehouse, someone is pulling supply off the board. These signals don't scream. They whisper. And if geopolitical stress accelerates, tariffs, supply chain disruptions, currency instability, that cascade speeds up. So here's the question most people aren't asking yet. What breaks first? Price discovery, delivery rules, or confidence? We don't know. We can't know. But we can watch the sequence. Markets don't usually break loudly. They drain quietly, until they don't. So let's map the paths forward, because there's more than one. One path is an orderly drawdown. Registered inventory stabilizes. Delivery demand cools. Premiums stay elevated but manageable. Paper markets absorb the stress. Price eventually reflects tightness, but slowly. In that scenario, leveraged shorts feel pressure, and patient physical holders gain optionality. Another path is a sudden squeeze. Delivery demand overwhelms available registered supply. Warehouses struggle to source metal. Cash settlements spike. Premiums explode. Paper and physical decouple violently, and price gaps. Rules get adjusted mid-crisis. In that case, anyone short without metal feels pain, and early physical holders benefit. A third path is administrative containment. Exchanges adjust margins or delivery terms preemptively. Price rises, but in a controlled way. Physical premiums stay permanently higher. Paper markets remain liquid, but less trusted for price discovery. Long-term physical accumulators quietly win, while traders expecting fast resolution get frustrated. Could reverse. Could stall. Could take longer than anyone expects. This isn't advice. It's pattern recognition. So what am I watching right now? First, the daily COMEX warehouse reports. In normal conditions, registered inventory fluctuates modestly month to month. Under stress, you see consistent weekly drawdowns and reclassification spikes. Ignore daily noise. Watch the trend. Second, Physical premiums versus spot. 2 to 5% is normal. Sustained double-digit premiums and delayed fulfillment tell you physical is disconnecting from paper. Third, lease rates and backwardation. Contango is normal. Backwardation in front months is not. When near-term metal costs more than future metal, someone needs it now. Fourth, volume spikes without price follow-through. When volume and open interest explode but price stays flat, pressure is being absorbed for the moment. And fifth, language changes, margin hikes, delivery clarifications, mid-cycle rule adjustments. That's the exchange responding to stress before it becomes obvious. If you're a trader, volatility here demands respect. If you're a long-term holder, you have to accept that price can stay disconnected from fundamentals longer than feels rational. My own approach, this is not a command, focuses on a few things: diversifying custody, understanding counterparty risk, avoiding leverage traps, maintaining liquidity, knowing how products actually settle, and tracking local premiums, because what you can source matters more than a quoted spot price. You can't know timing, you can know structure. Your job is to watch flows, interpret signals, and position accordingly, not predict the exact day stress becomes crisis. So where does that leave us? If you're watching supply instead of headlines, you're already ahead. You're not waiting for explanations after the fact. You're watching the drain in real time. I'm not telling you silver's going to the moon. I'm showing you where the stress points are, what the historical patterns look like, and what signals matter when paper diverges from physical. The valve and the tank, the delivery cascade, the quiet reclassification, the premium creep. These aren't conspiracy theories. They're market mechanics. They're visible, they're trackable, and they repeat. This could unwind smoothly. It could accelerate. It could take longer than anyone expects. Complex systems absorb stress until they can't, and the transition is always faster than the buildup. What doesn't change is this: physical reality eventually asserts itself over paper narratives. Always has, always will. If you stay disciplined, watch signals instead of chasing price, and understand the structure, you don't get shaken when volatility spikes. You're not panic buying at premiums you can't afford. You're not trapped in a margin call. You're the one who saw the setup before clarity became consensus. That's the edge. Before we wrap, quick engagement. Drop a comment. What signal are you watching this week? Price, premiums, inventory, lease rates? Let's see where the community's focus is. And if you know someone who's still only watching price, share this with them. Help them see the flows. Quick recap. Registered inventory is draining. Delivery demand is elevated. Premiums are rising. Lease rates are signaling stress. Volume is expanding against a shrinking physical base. Multiple paths ahead. Your job is to watch, interpret, and position, not predict. Hit subscribe if you're not already in. We'll keep tracking what matters while the crowd watches what's obvious. Final thought. Markets don't advertise breaking points. They leave clues for those watching the right indicators. You're watching now. That's the difference. Stay sharp.